Hey everyone, happy Thursday, January 2nd, 2025, the first market update of the new year. Didn't do one last week. It was the day after Christmas. Didn't think many people will be checking their email. Thought about not doing one today, day after New Year, but there was a lot that happened over the last couple weeks, so I didn't want to have to jam 3 weeks worth of thing in next week's one. So let's get right to it. I hope everybody had a great holiday season. Now we're back to the real world. First thing, going back to the Friday before Christmas, we got November PCE inflation data. Very important. The Fed's favorite form of inflation, and Fed is paying really close attention to inflation and unemployment to keep an eye on where we're going to go next with mortgage rates. So and their Fed rates. So taking a closer look at this PCE number, like I said, came in cooler than expected, which was great to see because there was some bad estimates out there. It's estimated to come in the headline number all encompassing at 0.2, came in at 0.1% month over month. Year over year, it was supposed to be at 2.5%. It came at 2.4, so that was great. Core number was up 0.1%, was expected to be up anywhere from 0.2 to 0.3%. And that year over year number drop was expected to be about 2.9 or 3, came in at 2.8%. So that was great to see. The headline, if we round it out, it rounded down to a 10, so it's a little bit higher than that. Year over year jumped from 2.31 last month to 2.44. That was because last November 2023, that was a negative number. So we're replacing last year's number with this number right here, and that's why that number will go up a little bit. But overall, this number is not bad. This is a good number. Core year over year went up from 2.79 to 2.82, so a slight change, but both of them rounded to 2.8, so that's why we got no change there. One weird thing in this, if you took out if you took out the hotels and motels, the cost of basically traveling and staying at these places from core, it would only came in at 0.082, so under a tenth. So sometimes this number, it varies. Sometimes it's helpful for us, sometimes it hurts us, but it goes up and down quite a bit. So it's one of those weird ones we can't really predict, but that was interesting. And then the two biggest wanes in core are shelter and healthcare. Previously, shelter was making up 0.37 of that number. It dropped down to 0.23, and healthcare dropped from 0.24 to 0.17. So good to see help there, especially the shelter number. I'm going to go more detail of that here in a second. And then the 3 month and the 6 month rate. So the averages over the last 3 months and the 6 months for the core, dropped from 2.72 to 2.5. And then the 6 month jumped a little bit from 2.3 to 2.38. But we know the Fed is looking at these shorter term averages as well. So it's good to see that 2.7 dropping to 2.5 as the Fed decides what they'll do at their next meeting. So as I said, we do have some help on the way, it looks like. So that shelter number coming at 0.23 was great. The shelter has been lagging behind real-time data. So the shelter number that gets reported in this and the other CPI inflation data has been higher than real-time data that we get from Apartment List and CoreLogic and these different, firms that track, rental prices. This December number is kind of low at 0.182, but that the shelter number at 0.416, if we got that same 0.23 number or anywhere near it, that would drop quite a bit. And keep in mind, we're always replacing last year's numbers. So when we get these December numbers, the new December's numbers will be replacing these numbers right here. So as you can see, once we get past December being a little lower in core, we got some higher elevated numbers until May in the core number, and especially in shelter. Shelter is, above 0.4 across the board, even a 0.5 in January. So if we get anywhere close to that 0.23 number that we got this month, it'll be replacing these numbers, and these numbers will drop quite a bit. And if these numbers drop quite a bit, the Fed is more inclined to cut rates, and that is what we want. Next thing we got Q3 GDP. So the third reading of our United States GDP, their final reading for quarter three of 2024, that came in higher than expected at 3.1%. Great for our economy, not good for what we were just talking about. The Fed could look at this and say, hey, we don't need to cut rates because our economy is doing great. So elevated, kind of Americans need to stop spending money, let's say. Next things we got both new and pending home sales for the month of November, and those both bounced back after worse numbers in October. So let's take a closer look at that. New home sales, so new construction jumps almost 6% in November at 5.9, now up 8.7% year over year. Keep in mind, October dropped by like 15% because there was hurricanes and bad weather in the south and the east coast, and that had a big effect. You're not going to start building homes in the middle of a hurricane, so that had that number drop a bit. Now we kind of recovered a little bit. So overall, good to see that recover, though. The more housing, the better. Like we've talked about, we need more supply. Pending home sales. So this jumped 2.2% for the month. And kind of similar, as you can see, the biggest jump was in the South. So again, probably similar. People in the month of October didn't want to necessarily go pending on a home sale or couldn't. Maybe they couldn't get insurance because they weren't allowing, things to close because of, all the weather that was going on in the South. So it makes sense that this number would jump so much in the South after that. It was probably a much lower number in the month of October. So overall, any sign of positive activity is good for our industry. It's good to see. Always still a lot of pent up activity there, though, pent up demand. So lower the rates get, the more we'll see those numbers jump. Initial jobless claims, we got two of them, both of them under estimates. This month was at, the previous 2 weeks ago was at 219 and 223 were estimated, 223,000. This Today, 211,000, 222,000 were estimated. So these numbers continue to be low. Just backs up the Fed's narrative that the job market's doing great. So got to keep an eye on those, but those have not been helping us at all. Where does that leave us? So right now, our average 30-year conventional is about 7.07. Came down from 2 weeks ago at 7.14. So we're hanging out a little bit above 7. Really, what we're going to need to see, like we've talked about, is inflation coming down and the job market slowing down. Probably going to have to see what happens here in the next couple months with the new administration, new policies, things like that to see real movement. Probably some volatility until we get a clear idea. Like I said, with the new administration's policies, how they'll have an effect on the economy, on housing, things like that. Important date. So coming up a week from tomorrow, we'll get the next BLS jobs report. That is the big one. So that means next week is jobs week. We get all the jobs data. We get another CPI inflation report coming out on the 15th. And then probably if I had to guess, another PCE inflation. I got to look somewhere between that, before that Fed meeting on 129. Right now, the Fed meeting is showing an 88% chance of no cut and a 12% chance they'll cut. So we want that 12% to go up. We want that 88% to go down. The faster they cut, the lower rates will go. But like I said, I would caution, I would think that there probably won't be a lot of movement until the new administration and their policies get settled and the market has a chance to digest everything. So overall, like I said, I hope everybody had a great holiday couple weeks. Overall, not the worst couple weeks in data. Still hanging around that 7 number, which we'd much rather be around that 6 number or lower. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, guys. Thanks.